Welcome to the 49th installment in Trading Strategy Guides Trading Education Series. Today, we're going to analyze a couple more actual trades that I took recently. Stick around. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. Today, we're going to look at a couple more actual trades that I've taken recently. We're going to focus on a couple of losers. You know, loser trades are part of your job as a trader. No trade strategy can be 100% accurate since they are not based on a crystal ball, but rather are based on probabilities. So the idea is to follow a trade that is going in your direction, but cut off one that is not. The question, of course, is, how do you know the difference? I get asked this all the time. How do I avoid head fakes and false breakouts? Well, you know what? You can't do it. Sorry, but there's no way to know in advance if a breakout is real or fake. So you watch the signs and act accordingly. You develop a rule set that has been tested thoroughly that will help you identify when a trade is not doing what you planned, and then you can cut it loose. Personally, I prefer to trade breakouts from geometric patterns on daily charts. The most important element is the volume behind the price moves. Trade volume will give you a clue to what the so-called smart traders, the big money traders, are doing. In the first trade example, I'll show you a little trick using volume that I've shared before. This trick will help you understand the importance of certain price moves. Our first example is a trade from the Trade Picks video series. This is the energy company pg&e Corp, or PGC. You can see the original setup on the video posted on March 15th, 2021. Look for a link in the upper right-hand corner of this video and a link in the description below if you want to check out that video. As in last week's video, I'm going to take advantage of TradingView's chart replay capability so you can follow along with this trade as it unfolded. I've queued the chart up on the March 15th candle using the replay feature. Then I'll tick through the candles and share how I managed this trade as it proceeded. Right here is the 15th. Let's tick one at a time as it proceeds. Now I want you to take a look at this candle. It's a pin bar. I want you to remember this, and we'll take a look at this later. The very next candle is our trade signal. You can see it happened on greater than average volume, and we have a close above the bull flag. So since we did have greater than average volume, I bought this full size right here at 11.90. First target is 12.29. Stop loss is 11.29. So let's see how this unfolded now. First day looked pretty good. Got us almost halfway to our target. And the second day everything went wrong. The candle closed right down here, back inside the bull flag. So at this point, I closed the trade for a loss according to my rules. So I closed this one at 11.51 for a loss of 38 pips and a 1.1% account loss. If you watch my videos, you'll know that I risk 2% on the trade. So if the trade ends up stopping out right down here, that will be a 2% loss. As it is, I closed this for just a little over half that amount of loss. Remember, we not only win by winning, we win by not losing. So this is 0.9% of the account that we didn't lose by getting out of this trade early. And this is where the market is currently. Notice that price tried to retrace, but hasn't done that and is looking kind of bearish right here. So this is likely to come down and hit our stop. So we saved 0.9% of our account by closing early on this trade. Now, I mentioned this candle right here earlier, and I want to talk about this for a minute because this is the little trick that I showed you can help you identify what the big money traders are thinking in terms of where price should go. Let's zoom in on that candle. Notice that price started here and pushed all the way up to the top of the bear flag and then pulled back and closed right here. So there was a huge amount of volume behind the push up and a huge amount of volume in the pullback. But how much? Which one is the most important part of this candle? Well, we figure that out by drilling down to a lower time frame. Now here's my process for doing that. Take a vertical line and drop it on this candle. That is just so that we can find this candle when we drill down. Now let's drill down to the hourly chart. Okay, you'll notice the vertical line I dropped here at the beginning of the day, and I have the period separators turned on. So this is the beginning of the day, and this is the end of the day. So these candles right here represent this day, starting with this one and going through this candle. So what you can see is a huge amount of volume went into these first two hourly candles, pushing it way up here. And a decreasing amount of volume went into this pullback right here until right at the end of the day, and it dropped with big volume. What this is telling us is there is a lot of interest in going long, and up until the end of the day there wasn't a lot of interest in pulling it back. But the biggest volume went into this pullback right in this area. The following day, which was the breakout day, a lot of volume went into that, particularly the actual breakout right here. This is the way you have some idea of what the smart money traders are interested in doing. The more volume that goes into a move, the more important it is in the grand scheme of things. Okay, let's take a look at the second example. This was a range trade set up on Nike Inc., NKE. I posted this on March 10th to the Comcash Alerts app for our Comcashers. Hang around to the end of the video and I'll share a little bit about our app. As before, I've queued this on the March 10th candle, and I'll tick through them one at a time and let you know how I manage the trade. Okay, this candle is March 10th. And there's our breakout candle on March 25th. I want you to notice that after the earnings report here, which was a positive surprise, there was a huge volume and a hard push down in the market here. I found that interesting that that happened on a positive news surprise, but nothing surprises me in the market anymore. But our breakout actually occurred on huge volume and a gap down again. One day here, the market opened down here and then closed right here. Now, I have considered creating a rule for triggers where the market is gapped like this, because in my experience, anytime the market gaps like this, it often goes back and fills that gap before it proceeds in the direction of the gap. But it hasn't been happening enough for me to spend the time to try to determine if there is a better way for me to trade these. So right now I'm sticking with the rules that I have. So I entered this trade on a short. Stop was 134.84. The entry was at 128.69 and the first target 124.51. Now, if you haven't been following my trade picks videos, you may not know this, but I use the ATR to determine what my stops and targets will be. And the stop loss is 1.5 times the ATR, and the first target is 1 times the ATR. So yes, I use a smaller target than I use stop loss. I will address that in the ebook and the videos that I'm doing so that you understand my thought processes here. A lot of traders will tell you that you can't be profitable using a smaller target than a stop loss, and in my opinion that's a little bit short-sighted, because anytime you increase your target, you are likely to reduce your win rate. I found this to be a good combination for my use, and I'll explain a little bit further in those videos. Let's go on. As you can see, the market immediately came up here and filled the gap. Now, that doesn't happen all the time. Those of you who have followed me for a very long time, like back in 2014, 2015, I used to do a trading room for Trading Strategy Guide's predecessor, Winner's Edge Trading, and one of the trades that we used to do is Sunday night gap fill trades. Basically, I had rules that got me into trades where the market had gapped a significant amount, and we made quite a bit of money doing that. I stopped doing it only because I wanted my Sunday nights back. I didn't like working Sunday night. So that was a personal reason, but it was a very successful strategy. I'll be glad to share that strategy with any of you guys who might be interested. In any case, the market closed the gap and the candle closed right there. So I took the loss at minus $3.43. Again, a 1.1% account loss on this trade. not the full 2%. And if we let this play out, you see that it still has not hit the stop loss, but has the potential to do so. It looked like it was trying to go back down here and did not succeed. Same with this candle. So I expect that this is going to break up here, and we would have taken a full 2% loss on this one. Like I told you guys last week, when you write your trading plan, you need to make a contingency for every event that could happen in the market. That should all be done in advance. I manage all my trades the same way, so it's easy for me to know what to do under all market conditions, and it removes most of the stress from trading. And like I said last week, I like to trade stress-free. Now, if you've been a trader for more than a minute or so, I know you've heard the phrase, cut off your losers and let your winners run. I spent a lot of years trying to understand what that looked like in practice. The most information I could get from any trading trainer was that you should close a trade when it wasn't doing what you expected it to do. What does that even mean? Does that mean that as soon as a trade ticks in the wrong direction, I should close it? Well, obviously that's not going to work because the market takes breaths in its movement, so it's going to go against you at some point. I've had other trainers tell me that I should always let it hit the stop, otherwise I'm not giving my strategy the full opportunity to become statistically valid, or some other stuff. Well, that just isn't right either. Well, I mean, I'm not saying they're wrong when they say that. It may apply that way to certain strategies, but I don't believe that that applies across the board. I finally concluded that I had to define what it meant for the trade not doing what I expected it to do, but it had to be a definition that corresponded to my own trading strategy. So for my strategy, which is to take explosive breakouts of consolidation patterns, I determined that the trade should be closed when the explosiveness has gone away. So I watch volume and volatility with the price action. And if the volume and volatility don't appear on the breakout, I don't take the trade. And if the volume and volatility disappear after I've entered the trade, I close it. The most telling clue of that would be a candle close back inside the pattern out of which I was expecting an explosion. So I definitely close the trade if the candle closes back in the pattern. But I will also close the trade if a new consolidation forms outside of the pattern. The takeaway here is, look at the strategy you're using. What early clues could suggest that the price is not moving the way you expected it to? Experiment with closing the trade at that point rather than waiting for it to hit the stop loss. As always, this is a test of probability, so one or two tests doesn't constitute what we call a representative sample. Test many examples and see how many of them go on and hit the stop loss, and how many of them turn back in your direction and hit the target. That is the ultimate test of what's working and what's not working. And as I always say, practice, practice, practice. You need confidence in your strategy so you won't give up on it during drawdowns. And that's it for today's video. Next week, we're going to look at some other examples from other people that I've made a few notes about. I mentioned earlier that I would tell you about the Cash Alerts app. This is an app built by our amazing tech people at Trading Strategy Guides. You get all of my trade setups and my trade tracking, and you can even chat directly with me. The trade setups from the Trade Picks videos are available on the app, plus the other trades I personally take every week. So we can chat about trades, and I'll be glad to answer your questions right on the chat page. Cash Alerts app is available for iPhone, Android, and desktop browser. Click the link in the description below for more information. And come back Friday for my strategy of the week, and next Monday for my trade picks. My videos come out at 3 p.m. New York time on those days. Don't hesitate to answer any questions you may have. Remember, the only stupid question is the unasked one. If this video helped you, smash that like below. Subscribe and hit the bell if you want to be notified of our videos in the future. Have a great Wednesday, and I'll see you on Friday.